We all know the price of our portfolio, right? It's right there on the statement. But what about the price it costs our body? Yeah, there's this hidden biological cost to market volatility, one that doesn't show up in dollars and cents, but in your stress levels and your long-term health. So today, let's uncover that hidden price. You know, in our minds, we picture our investments looking something like this, right? A nice, smooth, upward curve over time. But what if during that exact same period, your body's stress response looked more like this, a chaotic, jagged mess, like a seismograph during an earthquake? See, this is a chart of the stress hormone cortisol, and it shows that for the very same financial return, the cost to your health can be radically, and I mean radically, different. So how does our body actually pay this price? You know, Wall Street is obsessed with financial risk, but they completely ignore the biological risk. It's time we look at the actual science of what's happening inside of you when the market starts to switch. And to really get this, we've got to look at this fascinating study from the University of California. Researchers asked a really simple question. What if we could track the stress of regular, everyday investors in real time? So they equipped them with these little cortisol monitors and just watched what happened as the market did its thing. And what they found was, honestly, was stunning. During calm, low volatility weeks, the investor's average cortisol level was a pretty healthy 12. But during those crazy, highly volatile weeks, that number just skyrocketed.
All the way to 32. We are talking about a nearly threefold increase. And let's be clear, this isn't just about feeling a little on edge. This is a significant physiological event happening in your body, and it's being triggered entirely by numbers on a screen.
Now to put that number, 32, into perspective for you. Those are the same chronic stress levels researchers see in people with PTSD. And here's the kicker. The study wasn't tracking high-stakes Wall Street traders. Nope. These were just regular people checking their portfolios on their phones.
Look, a single spike in stress is totally normal. Our bodies are built for that. But when market turmoil makes that stress chronic, week after week, well, that's when the real damage begins. The long-term price of that kind of stress is so much higher than a temporary dip in your portfolio.
Chronic exposure to high cortisol creates this devastating timeline of effects. It starts within just a couple of weeks with disrupted sleep, which puts your brain in this constant threat detection mode. Then cognitive impairment kicks in. You know, trouble concentrating, memory issues. Within a few months, that stress starts hammering your cardiovascular system. And over years, it can lead to actual structural changes in your brain.
So let's just focus on that cardiovascular stress for a second. The numbers here are specific and frankly, they're alarming. We're talking about a 27% increase in a major health risk. Yep, you heard that right. A Swedish study found a 27% higher risk of hypertension, that's high blood pressure, for people who simply checked a volatile portfolio on a daily basis. Think about that. A common, simple habit directly linked to a really serious medical condition. So all of this leads to a fundamental trade-off. Just look at these two portfolios. Portfolio A is all in on stocks, higher volatility, higher financial return. Portfolio B is more balanced, lower volatility, slightly lower returns. Now on paper, Portfolio A looks like the obvious winner, right? But what happens when we add one more metric, the emotional and physical cost? Okay, so if the traditional approach is literally costing us our health, we need a better way. And it starts with a pretty radical idea. What if we optimized our portfolios first for our well-being and second for wealth? Let's actually explore what a peace of mind portfolio looks like. Let's do a quick gut check. Right now, imagine your portfolio drops 30%. What is your immediate physical reaction? Is it just mild discomfort and intellectual thought of, well, this happens, or is it a full-blown, heart-pounding panic attack? Your nervous system's honest answer to that question, that tells you your true risk tolerance, not some silly online questionnaire. So building a portfolio you can actually live with really comes down to 4 basic principles. First, you match the volatility to your actual nervous system's tolerance. You can figure that out using what I call the sleep test. From there, you create a volatility budget, and finally, you automate the whole process to take your emotions out of the driver's seat. So what on earth is the sleep test? It's really simple. Your portfolio is allocated correctly if you can go a full 3 months without even looking at it and still sleep soundly every single night. For some people, that might be an 80-20 stock to bond mix. For others, it might be 40-60. There is no one right answer, only what's right for you.
Now, I know what you're probably thinking. This sounds great, but I'll be leaving money on the table. But here's the thing.
Research from the Journal of Financial Planning found something incredible. Investors who optimized for their emotional comfort actually achieved nearly identical long-term returns. How is that even possible? Simple. The single biggest destroyer of wealth isn't a bear market, it's panic selling. A peace of mind portfolio is designed specifically to prevent that.
And hey, this isn't just theory. Look at this little personal experiment. For 2 weeks, a high volatility portfolio meant cortisol levels were high, waking up in the middle of the night to check the futures market. But the next 2 weeks with a peace of mind portfolio, cortisol was cut in half, slept straight through the night. The financial difference might be small, but the quality of life difference was, well, it was immeasurable.
And this really brings us back to the core idea of this whole thing. Your portfolio always has two prices. There's the price you see on your statement, and then there's the price your body pays, the toll on your nervous system, on your sleep, and on your long-term health. So I'll leave you with this one final thought. Wall Street measures success in basis points and alpha, but they don't have a metric for Sunday evenings ruined by anxiety, or family dinners where you're just mentally calculating your losses. Because at the end of the day, the highest returning portfolio in the entire world is absolutely worthless if it kills you before you ever get a chance to spend it.